Should you invest or pay off debt? This is such a common question on your way to financial freedom or on your financial journey. Because investing is very energizing. It's motivating to see your portfolio grow, more assets, more shares, more value, more dividends. That's fun to see. More capital gains. That's fun to see. And you feel like you have ownership, and you do. As opposed to paying off debt. Paying off debt is not as exciting. The money's already spent. You bought the crap or whatever. You already went on the trip. You already spent the dinner. You're already driving the car. The money's already spent. But now you have to pay for it. And this is not the fun part. And you feel like you're kind of taking a step back when you're paying off debt. Like you feel like you're looking backward. And investing, you feel like you're looking forward. But let us pause, take a deep breath, and critically evaluate the situation, right? So the question we said was invest or pay off debt. Like lots of things in life, it depends. It depends on your priorities. It depends on the interest rate, both of the debt you're paying off and the interest rate of the potential investments that you may invest in. In this video, we're specifically going to talk about high interest debt, specifically high interest credit card debt. So we're talking about 15, 20, 25, 30%. That's what we're talking about. If your investments are going to be getting most likely, if you're in S&P 500, maybe 10% or so. So 20, 25, 30%, you have to pay that off. It makes no mathematical or logical sense to not, right? If you are investing and you're making 10%, but the credit card is costing you 30%, that 10% have been eaten up that you gained from the investment, plus an additional 20%. So you see, that makes no sense. You have to deal with a high interest debt first. You have to. It's a matter of financial order of operations. You know, you remember when sometimes you remember in school they would have the order of operations, right? When you're doing a math problem, and it could be a complicated problem, and there was the order in which you did it. And the order was, I think the mnemonic was Pembroke, parentheses, exponents, multiplications, addition, and subtraction. Yeah, that's the mnemonic. So you first did what was in the parentheses first. Then you did the exponents next, and so on, right? You have to do it in sequence, otherwise you get it with the wrong answer. In financial terms, we have to go in order, right? We can't begin to invest over here when you owe this high interest debt over here. So high interest debt, that must be attacked with a vengeance. No joke. So whatever you have to do, that has to be dealt with. So if you have assets somewhere else, savings account, emergency fund, right? Or even if you have assets that you may have to liquidate or sell to get the cash, that has to be done. Because this high interest debt is costing you more over here. That has to be done. That's why it's great to have an emergency fund. But if you don't, it's good to have other assets. Liquidate it, sell it, or the other option is to work and get more money so you can pay off the debt. But just remember, the longer time you take to pay off the debt, the more interest will accrue. And we're talking about high interest. Okay? This is where the zero balance transfer comes in. If you can find a zero balance transfer, if you can find a credit card that's offering a zero balance transfer, where you could transfer all that high interest debt onto this balance transfer card, and there's usually a period of zero interest for like 18 months or so. There's a fee to transfer the money over, but that could save you tons of interest. So high interest debt, you have to deal with it. Even if you have to pause the investing for a minute, or liquidate or sell other investment that you have to get the money to pay it off, that has to be done. Now let's talk about other debt that are lower in interest, right? So the way in which we pay off these high interest debt is as much as we can, okay? We don't play around with minimum payment. You throw as much money as you can, because the faster you pay it off is as soon as you pay it off, the faster you pay it off is the faster that interest will stop. Okay, so high interest credit card has to be attacked first. Then you have other interest that may be not as high, such as maybe personal loans. You know, we're talking about 9, 10%. They have to be attacked next, because that's pretty much the amount of return you'd expect in the S&P 500. So that has to be addressed next. But first, the high interest, right? Then the interest that is next higher. And then, so higher interest, and then the other interest that are lower, then you attack that next. And then lower interest, then you attack that next. That's called the debt avalanche. So you arrange your debts from highest interest to lowest interest. You pay the minimum you pay as much as you can on the one with the highest interest rate, and the minimum on everything else. When that highest interest rate is paid off, you take the amount that you were paying on that highest interest and then pay to the one with the next highest interest, and then minimum payment on everything else. And you shoot everything, every dollar in that one until that's paid off. And you keep going until they're all paid off. That's called the debt avalanche method. And that will save you the most money, because you're going after the highest interest rate first. The other way, which Dave Ramsey talked about, is called the debt snowball, where you line up your debt from smallest to largest, regardless of the interest rate, and then you pay off the smallest one first, minimum payments and everything else. And then after that first one is done, you go to the next one. You take the money that you were paying on the first one, and then you throw everything in the next largest debt, minimum payment and everything else. And then you go to the third one. You take the money that you were paying on the first, second, and third, and you fight it in the third one, and you keep going until everything is done. That's called the debt snowball method. Dave Ramsey likes the debt snowball one because he said getting in debt is a psychological problem. And when you start seeing one debt disappear, you get more motivated. The second debt disappear, you get more motivated. As opposed to the debt avalanche, which goes by the interest rate, the wins may not come as quick, because the amount, you may be attacking an amount that's larger than it take you a while to finish. However, the debt avalanche does save you money. Other debts with lower interest rate, like mortgages, 3, 4, 5%, those are low priority, because you can invest the money that you would be throwing extra at those debts and get a higher return in the stock market. The path to financial freedom is not all numbers and math. A lot of times it's psychology. Sometimes we feel like we have more money than we do because we see a nice number in the account. But if you look over here and there's debt over here, high interest debt costing you, you have to deal with that, right? That's called priority. You have to deal with that first, right? In medicine, you'd call that triage. You have different levels of triage, like level 1, that's really serious emergency. Then you have level 5, maybe you stubbed your toe. It may feel like it's an emergency, but it's really not. So, a quick video to let us know that we have to be reasonable. We have to look at numbers, and we can't get too emotional, okay? It's nice to see numbers in your account, but if you have debt that's cost you the money that have to be dealt with first. Pause the investing. You may have to sell some assets, take the money, pay off that debt. Because a lot of times we feel like we're not getting a return on our investment by paying off debt, but you are. If your debt is 25% interest rate, when you're paying it off, you're getting a 25% return. You are getting 25% return. So that's how you have to think about it. Again, guys, the MD Investor with another video to increase our financial IQ so we can teach our children and break the cycle of generational poverty. MD Investor out.